Good morning, everyone. This is Dana from Next Gen, and I hope everyone has had a wonderful weekend. If you remember a couple of weeks ago, Carly's car was totaled, and she and her husband, Richard, decided to buy a new car. They weighed their options as to how they were going to pay for the car. Their options ranged from paying cash for the car out of their money market savings to taking advantage of their credit union's car buying service. They decided not to take the money out of their savings, which is earning 4.5% interest, but to finance the vehicle. When getting a loan, there are times when we should make comparisons that go beyond the monthly payments. Today, we're going to look at when we would want to compare. The purchase price on the car that Carly selected was $35,000. I'm going to include a auto loan calculator in the description below. So even though Carly and Richard was pre-approved for a 60-month loan, the interest rate was higher than they expected. So they looked back at their share certificate for a loan. So how the share certificate loan works is that you can borrow from the certificate for the term of the certificate. For example, Carly and Richard have an 84-month share certificate with an interest rate of 0.95%. The share certificate's balance is over $45,000 and it matures in December 2028. That means they can borrow the $35,000 for 48 months with an interest rate of 2.95. So when you're borrowing against the certificate, it is 2 percentage points above the interest rate you're receiving. So if they're receiving 0.95%, they will be paying back the loan of whatever the amount that they want at 2.95%. So the loan is secured by the certificate, not the car. So the worst thing that could happen was that they could forfeit a portion of the share certificate to satisfy the loan, which is very different than when you default on a car loan. The interest rate that they were approved for was for 60 months at 5.29%. So we have an auto loan for 60 months at 5.29%, and we're going to compare that to the share certificate loan for 2.95% for 48 months. Now, what you may not know is the difference between the monthly payments. So when you're looking at a loan, when you're borrowing, not the share certificate loan, but on an automobile loan or any other type of loan, the longer the term period, the higher the interest rate. So we're going to compare the monthly payments. On the share certificate loan, the monthly payment is $774. On the auto loan, for a longer period of time, it is $665. So on the face value, you would think that the auto loan terms were more favorable. However, the difference between the certificate loan and the auto loan is not only the interest rate, but also the loan term. So because the share certificate is 48 months, the auto loan is 12 months in addition to that. So with the share certificate loan, you're going to be paying back $37,152. On the auto loan, you're going to be paying $39,900. And I also talked about the differences between the default. With the auto loan, if they default, then they actually could have the car repossessed. If they default on the share certificate loan, they would forfeit the balance of the loan. So those are the two differences. So as you can see, even though the auto loan monthly payment is less, you're actually going to be paying more money. I know I talked about the default between what would happen with a share certificate loan or with an automobile loan. The good news is that Carly and Richard have a backup. So that's not going to be a challenge. But what I did want to do is to bring to your attention that looking at the monthly payment is not the entirety of doing a comparison. So what you want to do is not only look at the monthly payment, but also look at the amount of money you're going to be spending. I hope this information was beneficial to you. Don't forget to like, share, and subscribe to our channel. And I will talk to you soon, and have a great week.